Almost everyone thinks they can strike it rich in the stock market. You see the headlines, you hear the stories, and yeah, nearly 2/3 of Americans are invested in some way. So you'd think we'd all be on our way to an early retirement, right? But the reality? Well, there's a Grand Canyon-sized gap between how the average person invests and how the truly wealthy do it. It's not even the same game. And if you want proof, just look at this number. A jaw-dropping 75% of retail investors, that's you, me, regular people managing our own money, actually lose money over the long run. Let that sink in. They aren't getting richer, they're getting poorer. In fact, this is so common that the pros on Wall Street have a pretty brutal nickname for everybody else. They call them capital donors. I know, it's harsh, but it perfectly sums up what's happening. Everyday people are, often without even realizing it, just donating their hard-earned cash to the professionals on the other side of the trade. And what's the result of all that donating? Well, the wealthiest 10% of Americans now own almost 90% of the entire stock market. It's not just that they're playing a different game, they own the whole stadium. Okay, so let's actually dive into this. We're going to break down exactly what that stadium looks like. First, we'll cover the foundational stuff that actually works for everyday people. Then, we're going to climb the ladder to see the sophisticated moves of millionaires. And finally, we'll pull back the curtain on the super exclusive billionaire playbook. All right, first up, everyday investing. Before we get into all the crazy, complex strategies, you gotta have a solid base. These are the tried and true methods that can build real wealth for most of us if, and it's a big if, we can just avoid the common traps. And here are those traps right next to the solution. The losing strategy is what most of those capital donors do. They try to time the market, they chase some meme stock they saw on social media, and what happens? They panic, buy high, and sell low. The winning strategy? Honestly, it's almost boringly simple. You invest in solid, real companies, you stay patient, and you let the magic of compounding do all the heavy lifting for you over time. It all boils down to this really simple 3-step mantra: buy, hold, and compound. That's it. You buy into stable, proven stuff. You hold it, resisting that twitchy finger that wants to sell every time the market hiccups. And then you just let it compound. Let your money and its earnings grow so they can generate even more earnings. And the tools for this? They're totally accessible to everyone. We're talking about blue chip stocks, the huge, reliable companies like an Apple or Coca-Cola. Or even better, index funds, which let you buy a tiny slice of the entire market like the S&P 500. And of course, diversification, which is just a fancy way of saying, don't put all your eggs in one basket. It's simple, it's stable, and it actually works. Okay, now let's climb that ladder. Welcome to Millionaire Moves. Because once you actually have a serious amount of money, the whole game changes. The focus shifts dramatically from trying to make money to an absolute obsession with not losing the money you already have. It's all about defense. And the number one tool for playing defense is something called hedging. The easiest way to think about it is like this. It's financial insurance. You're basically setting up a side bet that pays off if your main investment goes down the drain. It's like insuring your house against a fire. You hope you never need it, but you're sure glad it's there if you do. And here's the perfect real-world story of how this works. Right before the dot-com bubble burst, Mark Cuban was sitting on $1 billion of Yahoo stock. He was worried, so he bought what are called put options. This basically gave him a safety net, the right to sell his stock at a guaranteed price, no matter how far it fell. Now, to pay for that insurance, he sold call options, which capped his potential profit if the stock went to the moon. And what happened? The bubble burst, Yahoo crashed, and his safety net kicked in. He didn't lose a single penny. That's hedging. Now, these strategies are seriously complex, so most millionaires just outsource them to hedge funds. These are these elite, almost secret investment firms. Some of them, like Ray Dalio's, make these huge macro bets on global trends. Others are event-driven. They try to profit from specific things like a big merger. And then you have the wild world of quantitative or quant trading. And these quant funds, they are on another planet. They don't use human gut feelings. They use math, physics, and supercomputers to find tiny, invisible patterns in the market and trade on them thousands of times a second. I mean, to give you an idea of how powerful this is, the most famous quant fund out there, Renaissance's Medallion Fund, has averaged 66% annual returns for decades. It's so successful, you literally can't invest in it anymore. But you know what? Even a world-class hedge fund has its limits. At the very top, we enter the realm of the billionaires. And here, investing isn't really about stocks anymore. It's about building and protecting your own private financial empire. And the ultimate tool for that is the family office. So forget outsourcing to a hedge fund. This is like having your very own in-house hedge fund, plus your own private equity firm, plus a team of the world's best tax lawyers, all working for one client, you and your family. And the toolkit they use is just on another level. We're talking private equity, getting into companies like Google or Facebook years before they ever hit the stock market. They use incredibly sophisticated strategies like tax loss harvesting to legally wipe out their tax bills. They even use strategic donations where they give away appreciated stock to a charity to get a huge tax deduction without ever having to sell the stock and pay capital gains tax on it. And that leads us to one of the most powerful and, controversial strategies in the entire playbook. It's called buy, borrow, die. Here's how it works. Step 1. You buy an asset that explodes in value. Let's say Tesla stock. Step 2. Instead of selling it and paying a mountain of taxes, you borrow against it. You take out low-interest loans, giving you millions in tax-free cash to live on. Finally, step 3. You die. Your heirs inherit that stock, and a legal rule called the step-up in basis can completely erase the original capital gains tax you owed. It's mind-bending, but it's perfectly legal. Here's a quick look at that tax loss harvesting thing I mentioned. It's brilliant, really. Let's say one of your investments makes you 50 grand. Normally, you'd owe tax on that full amount. But oh look, another one of your investments is down 40 grand. So your family office strategically sells that loser. The law lets you subtract that loss from your gain. So instead of paying tax on $50,000, you only pay tax on the net gain of $10,000. It's a huge savings that you can then just reinvest to grow even more. And all of this, the hedging, the family offices, the tax strategies, it all points to the single most important lesson of this entire explainer. For the ultra-wealthy, investing is not the primary tool they use to get rich. That heavy lifting has already been done. For them, investing is the machine they've built to stay rich forever. Which, of course, leaves us all with one really big question, doesn't it? If investing at the highest levels is mostly about preserving wealth, not creating it, then how on earth do people build that kind of fortune to begin with? Well, that's a story for another time.